Did you know that even if you have bad credit, you've missed multiple mortgage payments, and your house is in foreclosure, in many cases your bank is required by law to consider you for a loan modification, which you could use to save your home? So you're late on your mortgage and you don't know what to do. You've applied for a refinance with your bank, but you were turned down because you had bad credit. You're looking around and you see the option of a loan modification, and you think to yourself, is this the right option for me? I'm going to go through the top 5 most important things for you to know about loan modifications when you're applying so that you can get a successful loan modification and save your home. So what is a loan modification? How is it different from a refinance? A loan modification is basically an application with the bank that you currently have for them to modify the terms of the loan. They can either extend the loan out to 40 years or some other term, lower the interest rate, manipulate the loan in some form so that your mortgage payment is less. It's very important to understand how that differs from a refinance. A refinance, you're asking another bank to buy your loan at a new interest rate and basically give you another term. The biggest difference and the number one thing that you need to understand about loan modification and how it differs from a refinance is a loan modification does not depend on credit. It is very important to understand that anybody can apply for a loan modification, even if you have terrible credit. They do not look at your credit when they are applying for a loan modification. That a loan modification is based on the rules of the bank and the rules of the mortgage servicer. When you bought a house, you entered into contract with the bank and the servicer. The bank has another contract between the servicer and the investor. That contract controls whether or not the borrower, you, can apply for a loan modification. In most cases, there is a provision in most servicing agreements for the servicer to consider an application for a loan modification. The number one thing you have to understand is that a loan modification does not rely on your credit. You can have extremely bad credit and still apply for a loan modification. I have worked on thousands of loan modifications throughout my career, and I have never seen a person get turned down for a loan modification because of bad credit. There are some reasons why you would get turned down, but credit is not one of them. So if you're not applying for a loan modification because you think that you need good credit to obtain a loan modification, that is wrong. Don't worry about your credit. Put the application in because you might get surprised and it might be the easiest thing you've ever done to save your home. The next thing you need to understand is that you do not need to be current on your mortgage in order to apply for a loan modification. You can be late. You can be 1 month, 5 months, 5 years late on your mortgage, and if you still have the home, you can still apply for a loan modification. This is really important. Never give up on applying if you think you cannot because you are late. Does not matter. Remember, the bank has a contract between the servicer and the investor, and that contract between those two entities is what controls whether or not you can obtain a loan modification. I have never seen a loan modification rejected because the borrower was late on the mortgage. The whole point of applying for a loan modification is that you are late and you need assistance. If you're late, apply. If you've got bad credit, apply. The third thing to understand about loan modifications is that the new interest rate is not tied to the current interest rate. What that means is that even though interest rates might go up, might go down, doesn't matter. The bank is going to set the interest rate that they can use to get your payment down to an affordable level. I'm going to repeat that. Don't look at interest rate when you're applying for a loan modification. It doesn't matter that interest rates are low now or high later. That doesn't matter. It's possible that the bank might offer you a higher interest rate than what is currently available because the math works out in a way that even though that higher interest rate is offered, your payment still goes down. That is important to understand. So don't be discouraged if you see low interest rates or high interest rates. Whatever you're thinking about the interest rates doesn't matter. The interest rate does not control what the bank does when you apply for loan modification. There are other factors, but the interest rate is not one of them. The other big difference between a loan modification and a refinance is the bank does not charge you any points, interest, or any kind of penalties when you apply for a loan modification. When you apply for a refinance, you have to pay the mortgage broker, you have to pay closing costs, you have to pay all different types of costs, which you do not have to pay in a loan modification. There are no points, there are no mortgage closing costs when you apply for a loan modification. Now, it is possible that you would hire somebody to help you with it, but that's a separate issue. The same way you hire people to do your taxes, you might hire a loan modification company or an attorney to help you with the loan modification application. But the bank itself does not charge you anything for the loan modification. This is a big deal because sometimes mortgage points can be very high, and closing costs can be very high, and add tens, $20,000 to your mortgage, which you would not have to pay if you were to get a loan modification. Take that into account when you're deciding whether to apply for loan modification or try a refinance. The last thing you need to understand, and in my opinion, one of the most important aspects of a loan modification versus a refinance, is that, as I alluded to earlier in the video, most conventional banks must look at a loan modification application that is given to them by their customer. What that means is that even if you're late, even if you have bad credit, even if you're in foreclosure, even if you are at the last stage of a foreclosure, the bank still has to, in most cases, review a loan modification package for you. They will look at it and they will make a decision. Now, they're not required by law to offer you a loan modification, which is sometimes confusing to people, but if it makes business sense for them, they will look at it and they'll give you something that they think you can afford. Now, it doesn't always work out. That's what you have to understand. But when you're applying, you should keep all of these things in mind. This is a process that has been developed over many years, where the banks have created a program that helps people that generally cannot afford to refinance or cannot refinance for other reasons, specifically because of credit and because of late payments. Don't worry about that. Still apply. This is your home. And if you have some income, or if you have income from other sources like a renter, a family member, or some other source, you might be surprised that even after all the rejection and all of the different things that you've tried to save your home, that a bank might offer you something that you can afford. So I wish you the very best when you apply. My name is Diego Mendez. I'm a bankruptcy and loan modification lawyer here in Miami, Florida. I've helped thousands of people with their loan modification and bankruptcy situations. If you have any specific questions about loan modification, please put them in the comments below. I will answer anything that I can. If it's possible, I will. Subscribe to my channel, Debt Law, like my video, and I'll keep making videos about loan modification and other subjects that I think you might be interested in. Thanks a lot.